Good morning and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Jason Benowitz. He's a Senior Portfolio Manager over at Roosevelt Investments. Jason, it's great to have you back at MarketSite with me. We have a lot to go over looking at Q2 earnings and second half of 2018. But now that Q2 earnings season is officially upon us, what trends are you looking for? It seems as if earnings is a nice distraction from all the macro news we've had to contend with.
Yes, so we're excited about the earnings season this quarter. The economy has picked up in the second quarter and earnings growth looks to be strong. We think it could be greater than 20%, similar to the first quarter. Some of that, as I mentioned, due to the economy, and also the corporate tax cuts play a role. When we look at the US dollar, so it's weaker than it was a year ago, and that is a support to earnings. But when companies give their forward guidance, because the dollar has actually strengthened over the last few months, it's possible that they could revise that guidance lower because of their differing outlook on currency. Finally, one thing we'll be listening for on the conference calls is what companies have to say about the impacts of trade disruption. And so far, with a limited number of companies reporting, we're hearing basically what we expected to hear, which is that yes, it's a cause of conversation, people are talking about it and thinking about it, but it's not really impacting too much actions on the ground. And so that's somewhat encouraging. I think I would just close by saying, we think the markets are up 5% this year, and some of that basically is baking in the strong earnings report that we're seeing here. And so we wouldn't necessarily expect to see stocks move higher on these reports. It's really going to matter more about what happens in the back half of the year.
Right, and that's what I was going to ask you. What are your expectations for the second half of 2018? Do you think that we could expect the same kind of strength that we've seen over the first couple quarters?
So we do continue to be bullish on stocks. As we entered the year, we thought maybe we could see an 8 to 10% total return, and we're at 5% year to date on the S&P 500, so roughly in line with where we thought we would be. And as long as the economy persists and earnings continue to grow at a fast pace, we think stocks will do well. Now there are two risks that we're focused on. One would be trade risk, and the other is the flattening yield curve. And to some degree, these could cause choppiness, but ultimately what we've seen so far is that economy and earnings strength win out, and that's what we would expect for the second half.
And what about the flattening of the yield curve? Is it that much of a concerning move to you? Would you think it's more of a fundamental kind of move or more technical?
So historically, when the yield curve flattens, it's been for fundamental reasons. Investors revising lower their outlook on either growth or inflation. Now, as we sit here today in the second quarter, both of those things are actually picking up. So we don't really think it's based on fundamental factors. And there are some technical reasons that would explain it. So one, for example, could be U.S. pension funds had a very strong 2017 in the equity markets. If they take those gains and reinvest them in longer dated fixed income, that would weigh on the yield curve. A second thing might be just the international yields being so low that acts as an anchor on U.S. long-term yields because investors can play that arbitrage across the markets. So while it is true that we think this is largely a technical issue, that doesn't mean that it's not a cause for concern. So we think if the yield curve were to flatten further or even invert, that equity markets could be at risk. And there's two reasons for that. One is that it really just does weigh on investor confidence. And the second is that if you think about banks, so banks' incentive to lend is reduced when the yield curve inverts. And so that's an example of something happening in the financial markets actually impacting the real economy. So we think the markets would be at risk if there were to be an inversion. It's something we're watching very closely.
So for newer investors, when you talk about the flattening yield curve or inversion, does that compress bank margins? Why would we be so concerned about the shape of the yield curve? If you're newer to this, you need to understand how it impacts the macro market.
Sure. So historically, when long-term yields are actually lower than shorter-term yields, that's been a pretty reliable predictor of recession. So that's the number one reason why people are concerned. We're already very late in the cycle, and perhaps this is a signal that we're about to go over the edge. And then secondly, with respect to banks, of course, they earn money by lending long and they borrow money short, and so their net interest margin would be compressed if the yield curve were to invert. So that's the second reason to be concerned.
All right. Well, thank you very much for that explainer, and thank you for joining me at MarketSite, and thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.